Hey there, it's Tom Ryan, founder and CEO of ICR. Before we get into the next episode, I wanted to ask that you subscribe to the show. It'll help us get even more unique and interesting guests on the podcast and in turn continue to educate management teams and the growing ecosystem that creates value for fast-growing private and public companies. And while you're at it, head over to Apple Podcasts and leave us a 5-star rating. Very much appreciated. This episode is brought to you by IEQ Capital, an investment advisory firm that provides a premier endowment-style investment approach and family office services to eligible clients tailored to the unique needs of your family. The founding team behind IEQ Capital are entrepreneurs at heart with an uncompromising focus on clients and investment excellence. With over 30 years' experience as investors, they have a broad understanding of each asset class, deep institutional relationships, and a network that provides assets to exclusive private investment opportunities. Visit www.ieqcapital.com to learn more.
While neither Tom Ryan nor the show receives fees from IEQ Capital in connection with the sponsorship, nor is Tom a client of IEQ Capital, ICR must note the potential conflict of interest in recommending IEQ Capital in light of our potential for a future business relationship. All statements in this episode express the speaker's respected personal views and do not reflect the opinions or review of IEQ Capital.
20 years ago, I joined Wall Street. There was no such thing as a convertible advisor. 10 years ago, there was pretty much nothing.
In the rapidly changing economic landscape, companies are looking for a trusted compass to help them navigate through uncertainty.
Advisory penetration has increased so much. Clients are hiring advisors in 3 out of 4 deals. This year, 70% of the deals had an independent advisor.
Being a public company can be hard. Small missteps can have outsized consequences. I'm Tom Ryan, founder and CEO of ICR. And over the last 25 years, we've helped thousands of companies understand and navigate the stock market and the media. We'll demystify these and other increasingly complex stakeholder groups so you can focus on what you do best, building your company and unlocking your true potential. This is Welcome to the Arena from ICR. In the current macro environment, with growing inflation and financial uncertainty, it's no wonder companies are actively seeking alternative solutions to safeguard their businesses and their balance sheets. But today's guest is much more than an alternative. He's a game changer for his clients, helping them maximize their financial outcomes. Today, we're sitting down with Raj Imteaz, who serves as the head of ICR Capital's convertible and equity derivatives advisory team, where he focuses on complex capital markets transactions across all industry verticals. Raj advises boards and management teams on structuring and executing convertible debt transactions, convertible preferred and mandatory offerings, structured share repurchases, cap calls and call spreads, hedging and monetization strategies, and warrant management solutions. Raj joined ICR Capital from Matthew South, where he was the head of technology origination, advising clients on multiple convertible and equity derivatives transactions. Previously, Raj spent 15 years at Barclays, where he was a managing director in the equity-linked and hybrid solutions team and led the origination efforts across several sectors. During his career, Raj has advised on and executed more than 200 convertible and equity derivative transactions totaling over $100 billion of deal value. Let's enter the arena with Raj Imteaz.
So what's happening in the macro world, and it's something that we all know, with inflation being sticky and the Fed raising interest rates to combat inflation, a lot of our clients' debt rates have gone up significantly. So if you look at risk-free rates, treasuries, they're at 4 or 5%. And that means that even investment-grade companies, their bond rates are 5, 6%. If you're a high-yield company, 6, 7, 8, 9%. You were funding debt at 4 or 5% 3 years ago, and now suddenly cost has almost doubled. And if you're in that scenario, or maybe you have a term loan that's unhedged, and again, cost has doubled, what other way can you reduce the interest burden? You have to consider issuing a convertible, and you get a 1 or 2% interest. And now you are not only better off versus issuing debt, even you're lower than the 4% that you were paying a few years ago.
Yeah. And the equity market really hasn't been open. Companies don't seem to be accessing financing that way, which I think is another kind of check mark in favor of converts.
For sure, yeah. If you're okay with your stock price, but you really think you'd much rather sell stock up 30% or with a hedge structure up 100, up 75, again, a convert could be more attractive than issuing equity. Now, admittedly, there are some negatives of converts as well, and that's what we do for a living, to explain these negatives to our clients. But holistically, once you take a big picture look at converts, for a lot of clients, this is the flavor of the year.
Yep. So issuing a convert is different than going public and kind of some of the more traditional financings on Wall Street. What happens when a company wants to issue a convert? They call their banker, they don't use an advisor. Talk about that process and why an advisor is so critical if you're issuing a convert.
Sure. And so I'll start with an interesting data point. This year, 70% of the deals had an independent advisor. When I joined 20 years ago, I joined Wall Street, there was no such thing as a convertible advisor. 10 years ago, there was pretty much nothing. And the reason that advisory penetration has increased so much, clients are hiring advisors in 3 out of 4 deals, is that we really make the process easier for our clients. We take care of accounting. We work with the general counsel and law firms to bulletproof the documentation. But also we work with the client to make sure that the banks are truly giving our clients the absolute best pricing, best structure. We also stay with our clients over the life of the security to address any questions, and there could be corporate events over the life of the security to help them with those. So think of us as optimizing the deal today, saving our clients time and money today, but also being with them over life. And one interesting point there is that the market standard now is that the advisory fee comes out of the deal fee, the bank fee. Your bank fee doesn't really change whether you have an advisor or not, but if you do hire an advisor, a small piece of the deal fee goes to the advisor. So a lot of clients say, okay, you're saying you're going to save me a lot of time and a lot of money and a lot of hassle, and I have no incremental out-of-pocket cost. Why wouldn't I hire an advisor? And the process is, when you don't have an advisor, I mean, are you paying the right fee? Are you choosing the right banks? Are you splitting the fees the right way? Picking up coverage from incremental banks? Is your structure the right structure? We did the super micro deal. The client decided to go with the deal and then launched the deal within 4 or 5 days. And we really helped fast track that process. Generally, that's a 2-week process. Now, I don't recommend always doing deals in 4 days, but we can do that if that's what you want, because we are purpose built to help clients on convertibles.
Raj emphasized that having an advisor throughout the convertible process can really save companies a substantial amount of money and time. I wanted to take a deeper dive into the specific areas where an advisor's work plays such a crucial role in helping achieve those cost savings.
On a $1 billion deal, if you have a world-class advisory team like us, we would save you somewhere between $20 to $50 million versus if you didn't have an advisor. And there are many buckets of value capture, but think about the derivative hedge, the call spread structure. We run a very tight bid process. That in and of itself is about 1 to 2% of incremental savings. And sometimes banks would say, we will run the process for you. Well, banks are not built to run call spread bids. We have software services and systems in place to run this process, and we really save our clients real value there. When advisors are involved, The convert generally prices a little bit better. Stock price generally tends to perform a little bit better. The documentation is a little bit stronger in favor of the client. That means that in the future, in the event of various corporate events, you won't have to pay out tens of millions of dollars. Once you add all these things together, not to mention time savings, our clients are busy people and we save them hundreds of hours of time, it adds up to a very big number.
For sure. So, Raj, what I wanted to ask you is there are obviously some advisors out there, but when you talk about experience, when you talk about technology, how is your group differentiated from all those advisors?
So I'll start by saying I tell clients that advisory is like pizza. Even last night's pizza is good pizza. But if you're going to have a pizza, might as well get the best New York pizza straight out of the oven, and that's us. Why is that? So all the advisors do a good job keeping the banks honest and helping clients get a better deal. But there are several things we do that are differentiated. Number one, we have a multidisciplinary team, including a technical accountant, a derivatives attorney with 15 plus years of experience. And so we take care of a lot of the hassles that clients face when they consider a complex transaction. We take care of the accounting memo, which is a 50, 60 page complex document. We take care of that soup to nuts. Number two, we have a nuclear physicist turned quant who leads our tech efforts, and we've built some really cool software and an impressive tech stack, which allows us to optimize deals, get better market color than other advisors and even other banks, run the call spread bid process more efficiently, and just overall use technology to deliver a better outcome to our clients. The last 2 points are, I think, even more important. One is we are truly more holistic than others. Yes, our team is purely focused on conversion derivatives, but we are part of ICR, and ICR has a world-class investor relations and corporate communications team. So we have sector experts helping us on our deals. So we understand companies better, we're able to tell the story better, can push on pricing more on behalf of our clients, and we're part of a broader capital markets team. So we're not pushing for converts. Maybe you want to do other forms of capital raise, and we have experts for those structures as well. The last point is very interesting, Tom. Most of I would say all of our large competitors, they have in the last few years moved away from the pure advisory model. What I mean by that is they will do advisory when they have to, but in a perfect world, they would replace the banks and just do the deal by themselves and capture the full fee. I see why they would do that. It's much more lucrative. But my view is that in that case, you are a bank.
You're not an advisor anymore,
you're
right?
not an advisor. And so I tell clients that if you're going to be an advisor, then go hire a real advisor. And if you're going to hire a bank, go hire a real bank. So really, really interesting and unique differences versus our other peers.
Yeah, and it takes a lot of discipline to stay in your lane and not try and be somebody that you're not just for higher fees. And again, if you're acting as a bank, you're a bank. You're not an advisor, which is a real point of differentiation. The last thing I wanted to get to, Raj, was just some of the transactions that you've worked on that you can talk about publicly. I always think, the convert process, most CFOs and management teams haven't really done it very often in their career. It's highly complex. Maybe give us an example or two that really highlight what you do and the value that you bring to the table.
Sure. So we've been extremely busy, and we have several mandates. Those are obviously private right now, so we can't share. But in the last 6 months, we have advised on more than $5 billion worth of deals for marquee companies like Uber, Supermicro, Xerox, Lucid, etc. And the Uber transaction is near and dear to my heart, not only because it's an extraordinary company with an extraordinary management team, but Uber's treasurer is a former senior convertible banker and just an amazing finance executive. She just won the Treasurer of the Year award this year, and she hired us to help us execute her vision. So in her case, she knew what she wanted, but at the time of the deal, the time pressure means that you're pulled in multiple directions. If you can get 8 professionals who can take care of every single aspect of the deal for you. So Raj, you go talk to the banks and make sure that I get the best deal. And Matt, you go run the capped call bid process and make sure that we get the tightest bid. And Anna, you work with the derivative lawyers and general counsel to get me the best documentation. That's what we did there, and it was an amazing deal. Stock did well, and the client was really happy. Supermicro was similar, but they had a very fast track process. So the MO was get me the best possible structure, but also let's capture this market window and let's move fast. But while the process one might be fast tracked and the other might take 6 months, a lot of the work we do, helping with documentation, giving clients honest and thoughtful advice on the pros and cons, helping with fee and syndicate structure analysis, bulletproofing documentation, and then running some of the bid processes. They're fairly similar across deals.
Raj and his team have their finger on the pulse of the market, and the numbers don't lie. The demand for advisors is skyrocketing. And when you consider the wealth of expertise, experience, and lightning-fast support they offer, it's no wonder why. Having a trusted advisory team by your side is more than just an option, it's a strategic move. Partnering with an advisor can save precious time and money, and let's face it, that's something that no one can afford to miss out on. At Welcome to the Arena from ICR, we're working really hard to bring you exciting guests and great content. If you found this episode insightful, please subscribe to the show on your podcast app and leave us a 5-star rating. The more the show grows, the more interesting voices we can have on the podcast, and in turn, that should demystify a lot of the stakeholders around public companies and soon-to-be public companies. Thank you so much for listening. I want to thank Raj for joining me today on the show. If you have a debt maturity coming due, or you're the CFO or a management team, partnering up with an advisor like Raj is a no-brainer. This is Tom Ryan. We'll see you next time back in the arena.
References to specific stocks are not intended to be recommendations for specific trading behavior. Comments presented on this podcast are intended for informational and educational purposes only, and do not represent opinions or recommendations on whether to buy, sell, or hold shares of a particular stock. All investors are advised to conduct their own independent research into individual stocks before making a trading decision. In addition, investors are advised that past stock performance is no guarantee of future price performance.
This episode is brought to you by IEQ Capital, an investment advisory firm that provides a premier endowment-style investment approach and family office services to eligible clients tailored to the unique needs of your family. The founding team behind IEQ Capital are entrepreneurs at heart with an uncompromising focus on clients and investment excellence. With over 30 years' experience as investors, they have a broad understanding of each asset class, deep institutional relationships, and a network that provides assets to exclusive private investment opportunities. Visit www.ieqcapital.com to learn more.
While neither Tom Ryan nor the show receives fees from IEQ Capital in connection with the sponsorship, nor is Tom a client of IEQ Capital, ICR must note the potential conflict of interest in recommending IEQ Capital in light of our potential for a future business relationship. All statements in this episode express the speaker's respected personal views and do not reflect the opinions or review of IEQ Capital.